So today is Wednesday, March 31st, 11 a.m. section. Recording is on. What we're going to do today is pick up where we left off on Monday and complete the valuation of Walmart. And so again, you'll have to kind of continue in class with me doing everything I'm doing so that we finish this valuation. And that's the file that you're going to submit for your homework for Monday. So if you follow us in class at the end of today, you can submit. If you don't, you have until Monday, 10 a.m. to submit. And that is going to be your next homework assignment. But before we do, I'm logging into Bloomberg. Just want to check on the team to make sure that they met the requirement of cash and to quickly look at the rankings. While I'm logging in, just questions about anything? All right, so let me go ahead and share my screen. All right, let's look at idea. Section 101, second half. All right, guys, this is not 300,000. This is 303. So buy something. You need to be under 300. So under 300 means under 300, not 303. So please, this team, buy something today. Other than that, this will be the ranking of kind of where we stand today. And stay under 300,000. All right. So as I said, let's go ahead and go back to our Walmart model where we left off on, what day was that? Monday, today's Wednesday. And what we had done, just as a reminder, is we had taken the historical financials of Walmart for 6 years, and we have created a 6-year forecast based on the ratios repeating themselves as of 2021 repeated itself to create a forecast of economic statements and cash flows for the next 6 years. And what's most important about this valuation is over here, we have forecast of CFI going for the next 6 years. So what we are going to do today, we're not going to follow along with me, is we're going to then turn this forecast into an enterprise DCF valuation. So to do that, we're going to start with adding a new tab, and we'll add it over here on the far right. And I'm going to call this my DCF valuation tab for enterprise discounted cash flow. And I'll move this over here to be the final tab in our model. Right. So make it a little bit bigger so it's easy to kind of see what we're doing. But we're going to basically follow the Modigliani-Miller format for valuation. Right. So we're going to start out with operating value. And operating value is based on free cash flow. And the first 5 years of free cash flow are forecasted in the model. So in cell A2 here, I'm just going to do a relative reference off the CFI to my first year of forecast, which is H2. 2022 is the first year of forecast, again, relative reference. And we're forecasting 6 years, but the first 5 are going to be what we're going to call the defined forecast period. So I'm just going to take 2022, add a year to that, and then add 3 more years after that, copy and paste this down so that we're going through essentially 2026 on a relative basis here. Okay, so these are the next 5 years on a relative basis. Right? Now, here's the point. In our model, we have a forecast for free cash flow for each one of those years. So I'm going to put that here on this tab. So in 2022, our forecast for free cash flow, cell B2, equals off the CFI tab. 2022 is column H, free cash flow is row 13, so H13. And I'll basically put this as 2 decimal places currency. All right. In 2023, cell B3 off the CFI, column I, 13. (2024) off the CFI, J, 13. 2025 off the CFI, K, 13. And 2026 off of CFI, L as in Larry, 13. All right, so assuming our ratios come true here, these would be the free cash flows for the next 5 years. So our next step is to present value these free cash flows. So I'm old school. So I use the concept of discount factors, which the formula for present value is cash flow divided by 1 plus R to the N or T. So discount factor is 1 divided by 1 plus R to the N or T. And we'll multiply free cash flow by the discount factor to get the discounted free cash flow, because we got to present value this. So what is the discount factor? Equals 1 divided by 1 plus R to the N. So 1 plus R, what is the R? It's the cost of capital. Cost of capital we're using is on the assumptions tab. And in this case, it is cell B4. So 1 divided by 1 plus assumptions B4. Now that, because it's on the assumptions tab, which is the WACC, is going to always be cell B4. Put a $ in front of the B, $ in front of the 4. So that when I copy this down from cells C2 to C6, it will always be 1 divided by 1 plus R, which R is B4. Now, again, it's to the power of N. So for the first year, it's 1 divided by 1 plus R, that's C2. And C3, this is the second year, 1 divided by 1 plus R squared. So at the end of this, shift 6, 2 is squared. C4, 1 plus R cubed, shift 6, 3. 2025 is 1 plus R to the 4th power, shift 6, 4th power. And at the end, shift 6, 5th power. So that our discounted free cash flow is the free cash flow times discount factor. And that would be the present value, 84, 69, 68. Copy that formula down. This is again, cell D2 is just B2 times C2. Okay. So if I were to sum the operating value in first 5 years is the sum of those discounted free cash flows. So what we're saying is in the first 5 years, Walmart's worth about $43.5 billion, right? Running their stores from operations. That's the operating free cash flow value for the first 5 years. But we're not done, because technically Walmart's going to exist beyond 5 years. So 2027, which in our model is year 6, is the beginning of what we're going to call the continuing value or perpetuity period. Okay? So this is year 6 and beyond. So as a best practice, what you do is when you create a forecast, you always create an extra year in your forecast. So if you're forecasting 10 years, you do 11. If you do 5 years, you do 6. If you do 6 years, you do 7. That extra year is always the beginning of what's called the continuing value or perpetuity period, N+1. And the idea is that a company is going to last for a long period of time. We use a growing perpetuity to represent the value of the long term because it gets too difficult to forecast year by year. Okay, so that's the point. This is years 2027 and beyond. It's called a continuing value period. Now, this semester, we mentioned that in the McKinsey textbook, the continuing value formula is the key value driver formula, which is the rearranged growing perpetuity formula. And that's the one that we're going to use here. So if you remember, the key value driver formula is, go back to our lecture notes. It's been around since lecture note 1. So let me just quickly pop it up to remind ourselves of the key value driver formula. Zoom, stop, share. There's this formula. This is what we're calling key value drivers. This formula is the one we're using for the continuing value or perpetuity period. So what we're going to do is we're going to put this formula with the correct order of operations. So I'll take a little screenshot here so you can see what I'm about to do. Help you visually understand. Go back to Excel. We're going to put this formula into this cell, right, with the correct order of operations. Except, here's the point. I need to know expected profit. I need to know G. I need to know ROIC. And I need to know WACC, right? And so rather than putting it all here, these are going to be assumptions, right? So I'm going to continue down my list of assumptions. So my next assumption is my continuing value profit is going to be no plat in the continuing value formula. Then I'm going to need a continuing value ROIC. And then I'm going to need a continuing value G. So the point of the story is I'm going to actually put my assumptions here because I could change them. And then that's going to drive the formula here on the DCF tab. Okay? But I'm going to have all the key variables here on the assumptions tab that I'm going to use. Now I need some placeholders for what I'm going to use. So I already have a placeholder in the model for WACC 5.3%. So I need one for continuing value no plat. So what am I going to use as my starting point? Well, that's going to be cell B5 is going to refer to TII. My continuing value no plat is row 5 is no plat. 2027 is the continuing value period. So M5. Next, I have my continuing value ROIC equals cell B6 EPEOY M ROIC is right here after goodwill, row 16. So M16, 11.7%. And my G, I'm going to use 3%. And 3% is just a placeholder. All right, we're going to talk later about how to get a more realistic G, but this is your growth into perpetuity. And right now, we're going to assume that for a mature company, 2 to 3% is about what the U.S. economy is expected to grow long term. So we'll start out with growing the economy, but we'll come back later and we'll address how to do a more realistic G. But we have 4 numbers in here that basically drive the key value drivers formula. Now we're going to go build the equation. So back to the DCF tab. Cell B9 equals, just putting the equation over there on the right, left paren, building it all off of the assumptions tab. Profit, which is CV no plat, times left parentheses, 1 minus growth, CVG is B7, divided by ROIC, CV ROIC is B6, right parentheses, divided by left parentheses, WACC, which is B4, minus G, which is CVG, which is B7, right parentheses. So basically 716 billion. So assuming those key value driver assumptions come true, then Walmart will be worth an additional $716 billion of perpetuity. Now, that is a value as of the beginning of year 2027. But I actually need to bring it back to today. So January 1st, 2027 is basically the same as December 31st, 2026. So 2027 has already been discounted by the perpetuity formula. So, but I still need to bring it back to today. So I'm going to multiply it by the same discount factor as 2026. And that would lead to value times discount factor, present value of about 553 billion of operating cash flow today, leaving an overall operating value of Walmart to be the first 5 years plus the perpetuity period of about $597 billion. So if all of our assumptions come true and our ratios repeat itself, Walmart's worth a little under $600 billion in present value of free cash flow. Pause here for a second. Save my file, make sure. Questions? All right. If no questions, then we'll continue on and we're going to follow Ebitda-Miller. So if we remember Ebitda-Miller, let's go back here. Basically, what we're doing, I thought Ebitda-Miller was here. Wrong lecture note. Sorry. Go to lecture note 3. Back to Zoom. Ebitda-Miller. All right. So what we've just done is we've forecasted the free cash flow, which has given us the operating value. Now we need to do is we need the non-operating cash flows to get the non-operating value. We add them together. It's going to be our enterprise value minus debt equals equity. So we're basically following this process to do the value of the firm. Right? So let's come back over here. Continuing on, non-operating value. Well, this is where TFI helps us because in the TFI tab over here, we actually have listed the non-operating capital, right, when we did TFI because we rearranged the balance sheet to be operating and non-operating. So here's all the non-operating assets and liabilities. So over here, my DCF, what I'm going to do in row 13 is equal from my TFI excess cash, non-operating assets, and long-term investments. Just copy those 3 down in rows 13, 14, and 15. Now, the current value of those non-operating assets is the 2021 value that's listed on the balance sheet. Here's an assumption we're going to use in valuation. Companies don't do non-operating things well. It's not why you're in business. So what we're going to assume is that they're basically NPV 0 in the future, right? So we're going to say you're not really horrible with non-operating things, but you're not really good. So basically, we'll just say you're NPV 0. So they're not going to have any more value than they currently have today. Now, we can always change that assumption later, but for the most part, I don't invest in you because you do non-operating things. I invest in you because you do operating things. That's what you're good at. So let's value these based on the current value of the balance sheet. So we'll start out with excess cash. So excess cash, which is LD13, equals off of TFI. The current one is column G. It's what they have in the balance sheet today. And that would be row 10. Non-operating assets equals off of TFI. column G, and then row 11. And long-term investments would be TFI G12. Now, this is already in present value. So I don't actually have to present value these. So when I add this up, though, I get my non-operating, spell this correctly, value. This is their box 2 value, which is the sum of the three above, 13 to 15. So basically 10,885,000,000.98 in non-operating value. So if I add these two together, I get something called the enterprise value of Walmart, which is the operating value, the 597,050, plus the non-operating value, the 10,885.98, and that's going to equal 607,936.42. Okay, so that would be the enterprise value of Walmart. Again, questions about any of this? Pretty straightforward. All right, continuing on, I then subtract off the debt to get all the equity, right? And specifically, I then pay off the non-common equity to get to the common equity, because common equity is the residual value. It's what's left after everybody else has been paid. So again, that's what I do next. I'm going to start paying off people from the enterprise value that the non-common shareholders. So who are the debt and non-common equity that had to be paid? So the first one, and again, I can see that I might rearrange TFI, was retirement. Got to pay out the retirement related liabilities. Then I got to pay off row 22 off the TFI, the interest-bearing debt. Then I have to pay off the TFI, solving for common equity. So I have to pay off the preferred stock. And then I have to pay off the TFI, I have to pay out the minority shareholders. So after those four stakeholders are paid off, what's left will belong to the common shareholders. So what do I owe them? Well, today, 2021, D21 equals TFI. The current amount is column G. Retirement is 15. Interest-bearing debt, TFI G16. Preferred stock equals G off of TFI 18 and off of TFI G19 will be minority interest. So my common equity value will be the enterprise value minus the sum of those four. That's the residual. That's what's left. $538 billion worth of value. Now, if I divide that by shares outstanding, I get a common share price. Now, shares outstanding over here is actually going to change company by company. Okay? So I'm going to put on the assumptions, my next assumption down, the share count, shares outstanding. I'm going to make that a yellow cell. Now, where do I get the share count? We're going to get the share count from Bloomberg. So in Bloomberg, we are going to go to WMT, US equity. And there's going to be a few screens that we're going to use over and over again. And one is called DES, which is security description. It will be very helpful. And what the security description does, besides give you a summary, is right here. It gives you the current shares outstanding. So there's our share count right there. 2,817.1 million. 2817.1. 17.1. Okay. Now, over here on the DCF, I'm going to say D28, and I'm just going to refer to that cell of the assumptions.
Professor, I think we're still on your Bloomberg screen.
Sorry. Thank you for pointing that out. So what I did was I typed in on assumptions that share count, the 2817.1. And then over here on the DCF valuation, I just took cell D28 and just referred to, once again, equals assumptions, the share count, B8. And again, the reason I'm doing this is subtle but important, as I said this before, I don't want to hard code a number here on the screen. Because I'm telling you, I will guarantee you, if you put a number here that's a hard-coded number, then later when you change this model to somebody else, you'll can't figure out why the share price doesn't make any sense. And what you forgot is to change the share count of Walmart because it was on the DCF screen in row D28, and you just forgot about it. That's why it's so much easier to put things on the assumptions, because I know on the assumptions, these are the things that have been changing commonly. So hard-coded assumptions are just tough on your model, especially when you reuse something. So anyways, back to share price. Share price is the common equity value divided by the shares outstanding. So basically $191 a share. Right. So very quickly, we've actually built a model that forecasts a share price. And this is 191, and Walmart today is trading at, stop. I just switched to sharing my desktop, actually, because I'm going to be jumping back and forth. 136. Okay. So we're now about to go through a process that a lot of people skip, but is a requirement of this class. And it's called the as is valuation. That's just the language that I use in this class. And the whole point of an as is valuation is what we're going to do is we're going to match the share price in our Excel model to the share price that Walmart is trading today. Okay. Now, when people do valuation, they'll skip this step and they'll go straight to a forecast of what they think the company should be worth. And we're going to do that too. And we're going to call that the target share price. But before we do that, I find it instructive to do the current share price, value the current share price. And it's not that I agree or disagree with the share price. The price is the price. But what it does do is it helps me understand what assumptions are necessary to create that price. And then I can figure out whether I agree with those assumptions when I create my target share price. Okay. So our next step is to come up with a share price in our model that's close to the 136.25. Okay. So in order for us to do this, we're going to take a screenshot of the DES screen. And this is going to be important for your assignments. The reason why is because when we do these valuations, we're going to do them at a date and time. Walmart's share price, like any other company, is bouncing around. So what I'm going to do is I'm going to take the share price so that at the time of my valuation, it's whatever it was on the screenshot. So let me go back to my screenshot. Downloads. My screenshot is right here, which is 136.26. Okay, so that's the share price we're going to use for this class, 136.26. So what I'm going to do is I'm going to come over the assumptions, and my next assumption down is going to be the current share price.
Professor, we're still seeing your Bloomberg terminal.
I thought I went to sharing my desktop. Thanks for mentioning that. So stop, share, desktop. Try this. All right. So what I was doing is after I took the screenshot here, I then went to Excel And on the assumptions tab, I put in an assumption for current share price, which I'm going to make yellow. Next one row down. And this was the screenshot. And the screenshot of the DES screen was 136.25. So that is the price that we're going to all work towards in our model, 136.25. Now, the standard that I use, just an arbitrary standard, because the as is kind of something I do for this class, is $1. So you have to be within $1 of the current share price when you do the as is for your assignments in this class, with the exception of this homework assignment where you have to match me exactly. Okay. But generally, just I think $1 is close enough, right? So we need to get within $1 of 136.25 to have what I would call an as is model or a representative DCF that explains the current share price. Right. So the question then becomes, how do we do that? How do we change the model to get closer to being 136.25? Right. So a few things that we need to put in that are make sure we're realistic. The first is we need to make sure, besides having the current share count, we make sure we have a current WACC. So we're going to go back to Bloomberg and we're going to type in WACC. And this is going to be screenshot number 2. And right now, Walmart's WACC is 5.3%, hasn't changed versus what we have in the model. But nonetheless, I'm going to take another screenshot of this screen. And we're going to use WMT WACC. So there's the WACC for Walmart. So the second screenshot you're going to need for any company that you value is the WACC, because we're going to need the WACC at the time of the valuation, which obviously can change as interest rates and days change. So therefore, today it's 5.3%, which drives the current share price. All right, so the second screenshot, I don't have to change my data because I had it on there. Now, the third thing I'm going to need is got the WACC. I need to make sure that these ratios over here are realistic, right? I need to have realistic growth rates. I have to have realistic margins. I have to have a realistic tax rate, okay? You'll notice over here that these are in light gray. The reason why these are in light gray is because these are the 3 most important drivers of free cash flow on our income statement. And so therefore, from a 80-20 rule or even a 90-10 rule, most of your valuation is going to be based on these 3 numbers right here. Tell me your growth, tell me your EBITDA, tell me your tax rate. I'll figure out your gross cash flow, which is driving your NOPLAT and ultimately your free cash flow. So we're going to work backwards. We're going to start with the tax rate. We need a realistic tax rate for Walmart going forward. It's not the historical tax rate, it's the go forward tax rate. If you were paying attention, let's go back to Bloomberg. Right now in the news, still on the top news, the Biden administration is basically saying that they want to hike the corporate tax rate from 21% to 28%. And they also want to have a minimum global 21% tax rate on corporate earnings. So that way, if you're a multinational, you can't just use cheap earnings or cheap tax rates overseas to basically avoid paying US taxes. Now, I don't know if this is going to pass or not, right? Because I think the amount of Republicans supporting this will be 0. But regardless, the idea here is that this might go into a scenario of valuation as to what we think the tax rate might be. We might actually have higher tax rates. But for now, the tax rate's 21%. But regardless, we need a realistic tax rate going forward, and it could change. And so what is Walmart going to pay? Well, analysts are asking the same question. So in Bloomberg, there's going to be 2 screens where you can figure out where they're talking about the tax rate. So one is EBT, which is the event calendar. And is anybody here on the Bloomberg terminal at home following along with me live? Are you logged into Bloomberg right now? If you are, can you just let me know?
Yeah, I am, Professor.
Can you go to TA on the top and tell me if you can get to the screen? Do you have access to TA, or does it say need access?
Yeah, it looks like I have access.
Great. So this is an even easier one. TA is a function in Bloomberg called transcript analyzer. What it does, and I'll go back to EBT, is these are all of the earnings calls and all of the places where Walmart is presenting publicly, like at a brokerage conference or whatever. And by the way, on EBT, this is, for example, where the next earnings call will take place right here. This is where the analyst will also get the call-in number and the PIN code on May 18th at 7 a.m. to basically do that. But here's what's also happening. During the last call, Bloomberg in real time is creating, and you see the document over here, click on this, a transcript. So one of the other nice features of Bloomberg is every time a company is speaking publicly, Bloomberg is listening in, and it's using machine learning to basically create these real-time transcripts. So you got these PDFs, so you can listen to or the recording of or read the transcript of an earnings call, which is a very nice feature. But I'll tell you what's even more powerful. So once the transcripts exist, EBT is where you can find them, right? You can now go to TA, which is Transcript Analyzer, and basically Google search all of the company's transcripts and filings. So this is now, since I'm on Walmart, it's already filtered to Walmart. And so I can start doing a search. So what I'm going to search for is tax rate. Okay. And in this case, if I do an exact match for a keyword, then this is every mention of tax rate in any transcript that Walmart's had in their conversation. So Brett Biggs is their CFO. So this is when he was talking in the fourth quarter 21 tax rate. So I can then click on this, and then it will bring me to that transcript and the actual point in the transcript where he talked about it. So in the last earnings call, what he basically said was, just reading this in real time, blah, blah, blah. We're expecting quarter one operating to be flat, reflecting the presentation for about half the quarter and some tax rate fluctuations. Okay, unfortunately, he didn't give any guidance about whether he thought, other than fluctuations, what it would change. So second place where we look for a tax rate. If we can't find it here, this is the company talking about it themselves with the analyst. We're going to go to what's called BRC, which is the Bloomberg Research Portal. This is where you gain access to the analyst reports. Now, unfortunately, we don't have access to all the analyst reports because you actually have to pay for access to some of the analyst reports, and we don't do that as a school. So we get some, which are kind of free. But the some include like JP Morgan, Deutsche Bank is in here. Who else? Barclays is in here. So you got some big firm analysts in here. So what I would say is find a more recent analyst report. So for Walmart, it would be here, Deutsche Bank on February 26th, or Barclays February 24th, or JP Morgan on February 23rd. And usually in these reports, and I'll start with the JP Morgan one here, what the analysts will do, because they're doing what we're doing, they're building valuation models. And what JP Morgan typically does is, if you scroll down a little bit, they give some key metrics that they're summarizing in their valuation models. And typically one of the metrics that they throw in here is their forecast for tax rates. There it is. And this is the guidance they also threw in from the company. So the company was giving guidance for the tax rate of 24.5% to 25.5%. Okay. So you can also see what JP Morgan was using somewhere in here. And I'd be willing to bet you can actually search for tax tax rate in the PDF. So the guidance is 24.5 to 25.5. And that's the guidance. And this is the actual spreadsheet that JP Morgan has. And we can actually kind of look down here and try and figure out next variable is what they were using. Oh, here they are. JP Morgan's using 25%. They just split the difference in their model for Walmart going forward, right? So that's the point. We need a realistic tax rate, just like Wall Street needs a realistic tax rate. The company gave guidance. It's in the JP Morgan report. JP Morgan is using this number. I think this is a reasonable number that probably most people in the street are going to be pretty close to. So we're going to use 25% in our model. So long story short, let's go back to our model. Let's change the tax rate to 25%. Okay. Now, that is obviously going to change the share price. Actually made it higher, 227.63. So let's come over here. And what's going to happen is as we change the ratios, the price is going to change. So I'm going to be lazy. And every time I jump the screen, I don't want to keep jumping tabs. So what I mean by that is I want to put in here my model share price right here on the ratios tab. And then cell G26, I'm going to go to DCF valuation and refer to cell D30. So that way, every time I change a value, the share price changes and I can see it right here on the screen. I don't have to keep going back and forth tabs. And what I'm trying to do to remind myself is get close to the current share price of 136.25. So the other thing I'm going to do here is I'm going to put the current share price, which is the one that we're actually trying to get close to, which is the 136.25. That's what we have to get within $1 of. So that way I just got to put the two on the same screen so I can see what I'm trying to get to. But what I've done is I've gotten a more realistic tax rate for Walmart going forward. Right? Now I need a realistic revenue growth rate and a realistic EBITDA. Again, the analysts are trying to do the same thing. So here's the deal. Let's go to Bloomberg. And let's go to the screen is called EEO. On the EEO screen, for the next, this is the current year. These are the next forward years. And so just use talk language. Forward year 1, 2022. Forward year 2, 2023. 3, forward year 4. Actual estimate. That's how you can tell it's a forward year. EST, estimate. Okay. So this is the next year, year 2, year 3, year 4, right? Well, we're trying to forecast out the first 5 years. Well, the nice thing is, so are the analysts. So this is the consensus estimate database. So what's actually happening is these sell-side analysts are trying to do exactly what we're doing, including the guy from JP Morgan, whose research report we just read, Christopher Horvers. Okay, that's the research report. We just got the 25% tax rate. That little lock is the Excel model, which is the exact same model we're trying to do that JP Morgan's done, but it's locked and you have to ask for permission to get access to the model. And generally, when they find out you're a student, they're not going to give you permission. So we won't be able to see these broker models. But what Bloomberg is starting to do, MODL, is Bloomberg is actually trying to standardize the forecasted Excel models. They're hoping that all the analysts will start to forecast in a similar way. And then basically they're summarizing some of the key items that are being forecasted in the models here under the MODL. And some of the analysts that are playing ball with Bloomberg are giving them that data in that format. And then Bloomberg is putting it in here. So this is the forecast and the overall high, low, and then consensus. So what they're giving us is not just a consensus on revenue, but here's the entire forecasted balance sheet of Walmart cash flow statement, as well as other items, including some retail data. Okay. So again, this is where Bloomberg is trying to go next, and they're trying to get more analysts to kind of follow this format for companies, right? And again, while we're in this transitionary period, we're going to just keep it simple and start with all of these, then lead to EEO, which is Bloomberg aggregates these models, averages them, wisdom of the crowd average creates the consensus estimate. So basically, if you take the 30 analyst guesses, actually there's 34 analyst guesses for 2022 revenue. The high was 587,968. The low was 535,763. There were 4 outliers mathematically. The remaining 30 averaged to 553,296. That's actually how the consensus estimate is created, okay, for the company. This is revenue for the next 4 years based on the guesses. You'll also notice the number of analysts that are in the guesses goes down as we get further out. And it's not that the analysts aren't guessing these out years. It's just they don't want to put their names by the guesses in a public database. So the first 2 years is the most heavily forecasted publicly. They have forecasts, but not all of them are willing to put their names by it, because the point is when the real data comes out, you're going to be judged against your forecast and you don't want to look bad. So the first 2 years get the most forecast, and the outer years, you have fewer publicly available forecasts, but nonetheless, there are forecasts, but this is called the consensus estimate database. And I'm telling you that we're probably not going to create a better forecast for Walmart than what Wall Street, who does this for a living, is looking at Walmart and doing. So we're going to use this when we do our consensus estimates, or sorry, when we do our as is valuation. And the 2 numbers that we need are revenue and EBITDA. Okay. So long story short, for our model in assumptions, I need to know for, and my first year is 2021 plus 1. I need to know estimated revenue or sales. And then I need to know estimated EBITDA. And I'm going to do that for the next 4 years. 2, 3, 4. Okay. So what I'm basically going to do in yellow is I'm going to take the EEO screen, and we're going to take another screenshot. This will be screenshot number 3. And I'm basically going to put in these numbers into my model. So 553,296 goes right there. 567,138. 586,055. And 604,957. That in billions is the revenue estimate for the next 4 years. Walmart will be $605 billion in sales by 2025. Their EBITDA dollars $33.7 billion last year. This year, 33,831. Next year, 35,757. $37,299. And 39,674. Giving me an estimated Ebitda margin for 2022 is the Ebitda dollars, which is B13, divided by the Ebitda revenue, B12, of basically a little over 6%. So that would be the Ebitda margin, which Wall Street expects to start at 6.1% in 2022 and grow to 6.6% in 2025. That is based on the consensus estimate database, which is the wisdom of the crowd of what Wall Street is doing. Questions? All right. So here's the point. I now need to get my ratios. These EBITDAs need to match these EBITDAs. So back to 21 to 25. Starting in 2022 equals assumptions. B14. And I will just copy that out 4 years. And I am now going to unyellow this because I'm no longer calculating it here. I'm driving it based on these numbers. Everybody see what I just did? Going from 6.1 to 6.6, which is what we're actually using in perpetuity right now. Okay. Now, revenue growth rate. What I really need is I need these numbers to match these numbers. The way I do that is I had to solve for the growth rate to get them to match. So what is the 2022 growth rate? Well, the formula for growth rate is current year minus previous year divided by previous year. Therefore, equals current year revenue, 2022, is cell B12. Minus last year's revenue off the income tab, G3, right paren. Divided by last year's revenue, G3, says that my revenue growth rate has to be -1%. In 2023, what is my growth rate? Well, same formula. Equals left paren, current year, it's 2023, minus previous year, divided by previous year. It's going to be 2.5%. 2024. Just keep doing this so you guys understand the formula. It's current year minus previous year divided by previous year. And 2025 equals current year minus previous year divided by previous year. So those are the growth rates that basically make these numbers 553,296 match the 553,296. And since I've used those first 4 years, I'm using the consensus estimates, so those are no longer yellow. Still not getting the right share price, but I'm closer on my revenue. All right, Before I go further, questions by this so far?
I had one question. I'm just using some like prior Excel knowledge to like fill in this gap, but would you be able to use the what if analysis tool to find the revenue growth rate for like 2026 for like if you said that you want the model share price to equal the current share price and find that growth rate?
You could, although what I would actually say, the more important one is 2027. And the reason why is because if you look at our DCF, what we're really doing is we're changing this operating value to basically get to the share price. And most of the operating value is not going to be this year. It's going to be this period. Those are the two that are left. So changing the 13.6 billion, which is 2026, it's not going to have much of an impact. Changing the continuing value assumptions, it's going to have a gigantic impact. So that is what we're going to work on next. So this is the 2027 year.
Thank you.
But back to this, but yes, you can use a solver as well in this. So two last things. The two final numbers that matter are, think back to the key value driver formula. What is the G? What is a realistic growth rate and a realistic margin in a perpetuity? So these are my last three numbers. What's my these two growth rates, this Ebitda margin in perpetuity, which can be very important, and what is my G? So let's start out with the Ebitda margin. So going forward, we haven't gotten here yet, but in lecture note 6, we're going to get to multiples. And when you get to multiples in the book, we're going to get to a formula. And the formula is right here. And it's the formula for enterprise value to EBIT, or what the book will also call Ebitda. But the idea is, if you take the key value driver formula and you rearrange it, you get the same formula for enterprise value to EBIT. So this is the key value driver formula. It just solves for enterprise value to EBIT. Okay. So let's take a quick screenshot of this. Now what I'm going to do, put this here, screenshot, throw it in my model, cut it, and go to assumptions. Just so you see what I'm doing. So this is the key value driver rearranged, but what it gets me is an enterprise value to EBIT, right? And you might say, well, gee, why is that important? Well, the other formula that's going to be important is over here. Enterprise value to sales is the other formula, and the key value driver formula rearranged gets me to an enterprise value to sales multiple. So one of the things you're going to realize when we get to multiples is that the key value driver multiple is the valuation formula, and it's also the formula for all the multiples. It's just rearrange the math and you get a different multiple. And so you can rearrange it to get key value, enterprise value to sales. You can rearrange it to get enterprise value to EBIT. Okay. So here's the point. Enterprise value to sales equals margin times enterprise value to EBIT. Therefore, enterprise value to sales divided by enterprise value to EBIT equals margin. What is margin? That's EBIT margin. So the other important formula is that my perpetuity EBIT margin, which we're going to solve for, is based on the enterprise value to, actually move it 2 down, is going to be the enterprise value to sales multiple, or enterprise value to revenue, consistent language, divided by the enterprise value to EBIT gets us the perpetuity EBIT margin. Okay. Now, what we're going to also use is what's called the second forward year, which is this year. Okay. So in the second forward year, which is the first full year of forecast in 2023, if we go back to our EEO screenshot, second forward year, enterprise value to revenue, 0.77. So Walmart is trading at 0.77 EV to sales in 2023. In 2023, Walmart is trading at EV to EBIT of 18.09. Which means if I take this divided by that, I get about a 4.3% perpetuity margin. Notice what happens if I go to 2024. EV to sales is 0.74. EV to EBIT is 17.09. Notice how they're the same? Because that's the point, is that these equations have to sync together on a cash flow basis. Otherwise, there's arbitrage opportunities. All right, so we're going to use the second forward year, but I'm telling you the multiples are basically telling us, because we know the tax rate, we know the ROIC, we have a G, got a WACC, we can solve, we can back into these numbers. So back to the market, we know this has to be the 4.3% perpetuity EBIT margin. So let's come over here. In our ratios, this number has to be 4.3% in perpetuity. That's the only way that the valuation works. Right now it's 4.6. So in 2027, the market is not expecting a 6.6% EBITDA. It's expecting a 6.3% EBITDA. Share price lower. And so if I want to think about 25 to 27, I'll put this somewhere in the middle, 6.4. So that's the first thing that we needed to change. We needed to change a more realistic EBITDA margin into perpetuity. Questions about what we just did?
I thought the perpetuity EBITDA margin was like 4.3, was it not?
It was. That's this.
Oh, got it. Okay.
So in order to get this, I can't directly change this. So I had to lower the EBITDA to make that 4.3. So this went from 6.6 to 6.3. That's how I got this to be 4.3.
And it's
Thanks.
okay to hard code in like that. You don't want us to use any equation or formula.
Yellow. It's yellow. Because I will change it by company. Because I'm not changing this one, I'm changing this one. Okay. All right. So last but not least, told you, revenue growth, 2-3% makes sense for Walmart. So really, it's G. 3% G is too high for Walmart. It's probably going to be more like a 1% G. Now I'm closer to my model share price, 127 current share price. So I'm going to make my G 1.1. $1.2, somewhere in that range. Probably more like 1.3. All right, 1.4. For the person that asked about the solver, this is why it's easier to use a solver. But the point is, somewhere around a G of around a 1.4-ish% range is probably what the Wall Street's using to justify a share price of 136 a share. You're looking at a model that's approximating Walmart share price. This is what we call the as is. And this is where you have to get to for homework 8. 135.55.
Professor,
Yes.
can I just use, I think I used 1.43 and I got 136.24.
You mean versus, I don't want you to do that for today. All right, I'll tell you what, here's what I'll do. I'll do 1.43. 1.43, so we'll have that. So you just set the bar for the entire class. 1.43. I was good enough for the $1, but we'll be to the to one penny, 1.43%. But the point is, for grading purposes, I need everybody to have this share price. So the share price you need for your grade on this homework assignment that we're going to check is 136.24. So when the TAs check this, they're going to check this share price and they're going to check these DCF values to make sure that they're exact. And they're going to check these assumptions. So that's what they're going to check for homework 8.
Can you say that one more time? What they're going to check?
Basically the assumptions tab, the DCF valuation tab, and they're going to make sure that your share price is matching within 1 penny at 136.24.
Gotcha.
Also, Professor, I know this is very specific, but I'm just curious. For the assumptions tab, when we're having the EVs to revenue and EV to EBIT, those multiples, should we make those yellow?
You mean these cells?
No, like the 0.77,
Oh.
0.74.
Yes, we should. That was a good catch.
Okay.
Thank you. Yes, they should. Because those are going to be something that are going to change company by company. Because the whole point is if we switch Walmart to Costco or Target, then we'd want to put in their multiples to figure out what the market's using for their perpetuity EBIT margin. So very good call out.
Thanks.
Yeah, I did miss that. So I would not get a perfect score in my homework either. All right. Other questions about any of this? So what we've completed in our second day of the Walmart valuation is the as-is Walmart valuation. We've built a DCF model that forecasts 6 years. We took that model, we created a DCF cash flow following Modigliani Miller to a current share price. And then we went through a process to basically use real world data to match almost exactly the current share price. What we're going to do next on Monday is we're going to create 3 more share prices for Walmart. We're going to create a target share price, which is what we think the share price is going to be in 12 months. That will create the concept of a buy, sell, hold opinion, the delta between the target and the current. We'll then create a range, and we're going to call it the bull and the bear. Because what increasingly people want to see on Wall Street is, don't just tell me what the target is, tell me what my upside and downside is in the stock. And we're going to talk about how to do that with this model so that we can create the range for the company. But that's where we're going to go next. And then once we finish that on Monday, then you're going to be doing this for your own company as an individual assignment. And then as a group, you're going to be doing this on General Dynamics. That's going to be your next group valuation project, but that's what's coming up, right? So questions about anything we did today before we wrap up? Homework 8 is due Monday, 10 a.m. I'm going to basically go right now to allow you to start submitting. So if you have finished this, you should be able to submit within the next couple minutes. If not, if you haven't gotten to this point, watch the video, get to this point, submit by Monday, 10 a.m. because we're going to pick up right here with this model as we do the target, the bull, and the bear. Okay, but we're 95% complete with our valuation model. Now it just gets down to process. Any other questions?
Do we also need the Bloomberg screenshots for the homework or just the Excel?
For
Okay.
this one, you don't. I'm giving you the Bloomberg screenshots as a recipe so that when you have to do this next week for your own company, you'll know what screenshots to get. But when you do this for your own companies, then you'll need to give me the screenshots as well, just to make sure you're getting the right data. But the point is, I do the screenshots now so you know what data we need to get from Bloomberg. But for this assignment, all you need is the Excel file. Don't need the Bloomberg screenshots.
Thank you.
Sure. Any other questions? All right. Everybody stay safe out there. Have a good week. We'll see everybody on Monday. And again, make sure you submit this file. I'm going to go turn the submission on for homework 8, and then I'll see everybody next Monday.
Thanks, Professor.
All right,
Thank
bye-bye.
you.
Thank you.